Good morning and happy belated New Year. It is the 10th of January, Wednesday, 9:27 a.m. Pacific time. I wanted to show you a trade that I don't normally do, but it's interesting and I wanted to mix things up a little bit. So, what I did was I did a bull call spread, which I'll explain what that is, coupled with selling another call option with different strike, different expiration, and combined, I am calling it a ratio calendar spread. And so just look at this part here, the 23rd, these two. Ignore this for the moment. Okay, so this is CrowdStrike. And I'll do another video right after this as to why I chose CrowdStrike. But a bull call spread means A, I'm bullish. I want the market to go up. At least I want this stock to go up. And so when you trade options, if you want the stock to go up, you can buy call options to capitalize on that. So if you look at this price here, it's 280 and 28 cents. Okay. Obviously that'll change constantly, but that's where it is now. So I bought an at the money call option. At the money means the strike price is extremely close to the underlying stock price. It could be off by obviously less than $1, but it's really darn close. That's at the money. So if it was, let's say, this price, this is out of the money. If it was further away, then it's further out of the money or far out of the money. So I spent for this call option, you see there's no negative sign. If there's no negative sign, I bought it. If there's a negative sign, I sold it. Okay. Obviously it's 1 to 1. So 1432, obviously you multiply that by 100 because as you know, one option leverages 100 shares of stock. So we multiply this price by 100. That's $1,432. I didn't feel like spending that. So what I did was, in addition to buying this, I sold this option, collecting $1,187. All right, buying and selling. What's the difference between the two? It's a net purchase. It's a net cost, a net debit. So between these two, not factoring in commission, it's what $245 out of pocket plus commission. Okay, so that's not too much, compared to 1432. But what's the downside? Well, the downside is obviously the market could drop. If the market drops, then I lose less because I put out less. If the market goes up, I put a ceiling on my profit. So sky is not the limit on this trade. You see the strike price and this strike price, the difference between that is $5, or as option traders know, would be $500 because 5 times 100. So to put up 245, potentially gaining 500, well, that's a decent risk to return, in my opinion. So this expiration here is just over a month and a half or so. Okay. Now, what I wanted to do in addition is I wanted to save even more money. So I sold an option that expires not this Friday, but next Friday. Okay. Because options generally expire every Friday. Unless you're talking about the Qs or the SPYs, ETFs, they have daily expirations. But focusing on this is Friday. So you notice this is 295. So that's further away. For this to go to 295 is obviously less likely than it going to obviously 280 it's here, or 285. So I collected 144. Okay, now it's 142 now. So with that couple bucks here is what I'm in a floating profit. So the point is, I wanted to save even more money. So now my net cost is just over $100. All right. So there's obviously two scenarios. This can go up, this could go down, or actually three, or it could do nothing. It can stay exactly where it is, which is unlikely. If it goes up, all of this will gain value. So let's say it goes all the way to 295 before this date. If it does that, these will be deep in the money. So I would max out my profit at 500. Okay, if I do that, fantastic. I turned about $100 in cost to 500. Okay, if it goes past this, I would have to roll this or just buy this back for a loss. All right. So what I'm factoring in is the time value. Time decay is setting in more aggressively for this option than for these two because this expires over a month sooner than these two. So if the market does drop or stay where it is, then all of these can go to zero. However, I risk about $100. So it's not as much of a risk as if my initial plan of just buying this and spending $1,432, I have less outlay of cash and less risk of loss or less dollar risk. So that's basically how that works. Now, I'll do another video on why CrowdStrike was my choice, and stay tuned for that. Thank you very much for watching. Hit the like button, hit the subscribe button if you are interested in learning more about options and trading, and I will see you on the next video. Have a nice day.